With interest rates going up as fast as they are, as high as they are, all of a sudden, an ARM got a little sexier. So what am I talking about? An ARM is an adjustable rate mortgage. Many people haven't talked about ARMs for a decade. And the reason why is because the 30-year fixed interest rate when you're purchasing a home has been so good and so low for so long. In fact, it's been coming down for the last 10 years, and we know the last 2 years have been especially good. Well, that 30-year fixed has gone up quite a bit since January 2022. And now all of a sudden, people are looking to expand their qualifications by using an ARM because a lot of times they have a lower interest rate than a fixed in a rising interest rate market like the one we're in today. So I want to talk a little bit about how do you define an ARM and when should you or should you not use it. So let's talk about just the breakdown of the product. So many times when you talk about 30-year fixed or 15-year fixed or 10-year fixed, you're really just talking about the period of time. And then maybe it's a different choice of bank. And then of course it could be an FHA or VA or USDA or conventional or jumbo. But in an ARM, the product tells you all the numbers. So I'm going to read one off to you and then I'm going to break it down. So here's a product for an ARM. It could be a 5/6 SOFR 2.75 215. What is that? That's like gibberish. That's like, what does that mean? So let's go through that. And I first want to define that SOFR because many times in the past we had talked about a LIBOR, which is an index. When you're looking at an index for an ARM, you're typically looking at interbank indexes, not something that one bank or even one country would use. So SOFR is a relatively new index that had been switched to instead of LIBOR, and that's using the secured overnight financing rate. That rate today is 0.79. It was 0.05% just in January. So it's been going up with the Fed rate. So let's get back to that ARM in the breakdown. So a 5/6 SOFR 2.75 margin 215. The first part, 5/6. So it would say 5/6. That 5/6 means that it's fixed for the period of time that the first number is. So a 5/6 or 7/1 or 10/1, that first number, in that case the 5 or the 7 or the 10, is the number of years that interest rate is fixed at whatever rate you lock in at. So that 5/6 gives me a fixed rate for 5 years. Then the 6 means 6 months. A lot of times you'll hear 5/1, right? And that means it's fixed for 5 years and then it changes every 1 year. But we are seeing 5/6s a lot lately, and that means it changes every 6 months. So it's fixed for 5 years, then it can adjust after the 5-year period, but then not again for 6 months, and then again every 6 months. So 5/6. SOFR is the name of the index. In that place you might have seen LIBOR, but in this case, many times it's based on that SOFR index. And then we're talking about the margin, the 2.75. That means after that fixed period of time where you locked in that interest rate at the time of originating that mortgage, at the time that that fixed rate comes due, it's based on the margin to whatever the index is. So if the index is 1% and my margin is 2.75, that means I have an interest rate of 3.75. Now, many times they have a floor. So you'll want to ask that question, is there a floor on this product and what is that? So let's keep going. So we talked about the 5/6, the SOFR, the 2.75 margin. Now we come up with the last 3 digits and they're separated by slashes, 2/1/5. And again, this is just one product. There are many products to choose from when you're looking at ARMs. That 215 means that on the first time when that fixed period comes due, so right at the end of 5 years, my interest rate can go up by a maximum of 2 percentage points. So if I was locked in at say 4%, the highest my rate could be is 6%, 2% higher. The second digit is how much can it go every period. So if I have a 5/6, that means every 6 months my rate can change, and after the first time, which could have changed 2 percentage points, thereafter it can only go up by 1 percentage point or change by 1 percentage point. Then the last digit is the lifetime max, and that on this product was 5. So if I locked in at a 4%, then that means that the highest that interest rate can ever go is 9, 4 plus 5. That helps you figure out what is the all-in risk if I take this product. Because that's what I want to talk about. When is it good and when is it not good to do an ARM? Well, I'm going to tell you. So it's good if you know you're going to move, right? Like maybe you're in the military, or maybe you have a temporary job, or maybe you know you're buying a home that's too small for you and you want to start a family or get married. And that home, you're fine thinking, I'm not going to live in this home more than 5 years, maybe 6. Maybe I'll have 1 adjustment or 2 adjustments, but I can live through those, right? So what's the period of time you'll be in the home? That's going to help. Maybe I have some money that I know that I'm going to inherit, and I'm going to pay down that mortgage so much that a change of payment isn't really going to affect me. Or in situations like today, I might be counting on rates dropping, and I'm going to refinance that loan and take advantage of lower fixed rates in the future. That might be a reason to take an ARM today. When would I not take it? I wouldn't take it if I thought this is my forever home. This is my long-term home. This is the home I want to raise my kids in. That would be the kind of time, even if I was counting on a refinance coming and I knew that it would hurt if it didn't, and if the rates started to go up and that ARM started to adjust, I'm going to protect myself even with a slightly higher 30-year fixed in that case. Or if I want to convert that home to an investment, I want to lock in my costs so that when I rent it out, I know what the cash flow is. I don't want that loan variable when my rents might not adjust that fast. And then the last reason I might not use it is if my income is fixed. Maybe I make a limited salary, or maybe I'm on a fixed retirement income, or maybe I have the kind of job where I know what my salary increases will be every year and they're small. Well, if I have a fixed income, then that kind of change that could happen 5 years down the road could be substantial, and it could cause my budget not to be able to absorb that mortgage and could put me in a position where I have to sell or lose my home. Well, that's not a place you want to be. So jumping into an ARM can give you an advantage because right now those interest rates are lower than the 30-year fix, but that advantage comes with risks. So make sure you're asking all the right questions and that you're educating yourself on not only your options, but what might come in the future. Well, my name is Nicole Rueth with the Rueth team of Fairway Mortgage. It's always my pleasure to serve. And if you have any questions about ARMs or other loan products for your scenario, give us a call today.